I was supposed to be on Patrick Bet David that day, but he had to move me to August now. So gold revaluation is a different thing. I think that ultimately, first and foremost, they should market to market. It's valued at 42.22.
It's so stupid.
Revaluing it is something that I actually believe could happen, but I felt that it was too early for it to happen. I didn't think it would be revalued on July 4th. Ultimately, still may be revalued. James Rickards talking about revaluing it to 24,000, or Luke Roman said they'd let it go up to 7 or 8,000 and then revalue it. Perhaps maybe that means market to market.
The global financial architecture is rapidly approaching a critical juncture where traditional fiat systems can no longer sustain mounting debts without systemic failure. As central banks quietly accumulate massive gold reserves, a quiet structural shift is underway behind the scenes of global markets. AndySchectman, a prominent precious metals expert, emphasizes that the revaluation of gold is not just a theoretical concept but an inevitable mathematical necessity to stabilize staggering global debt. He argues that this adjustment will likely occur as the market establishes new price-setting exchanges focused on physical delivery over speculative paper shorts. This systemic reset could drive gold prices organically to $7,000 or $8,000 before an official revaluation occurs, with some economists projecting ultimate targets as high as $24,000. Under Judy Shelton's proposed framework, issuing gold-backed treasury bonds remains a highly viable path toward establishing sound money principles. Now, we present the clips from Andy's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I talked less about a revaluation. I said that, I thought that they would let it rise organically and maybe market to market. And there are people who are convincing. James Rickards talking about revaluing it to 24,000, or Luke Roman said they'd let it go up to 7 or 8,000 and then revalue it. Perhaps maybe that means market to market. But I did believe, and I still do believe, that Judy Shelton's idea is the best I've ever heard. And what I did say, and I always gave her credit for it. I got some heat on X for it, and the person said, well, you didn't mention Judy in the snippet. I'm like, it's a snippet. And I checked with AI. Her name was mentioned 7 times in the video, and I always have given her credit. Look, when the former nominee to the Federal Reserve and Trump's advisor, in 2 interviews, one with me, one with Michelle, in a best-selling book right over here that I have, that I read, and in her X page, and on every interview, more or less says in no uncertain terms, Trump loved the idea and she believed very strongly that he would potentially issue them on July 4th. When I was asked by Michelle a week before, I said 50-50 chance. I'm disappointed. It doesn't mean it's over. Gold revaluation is a different thing. I think that ultimately, first and foremost, they should market to market. It's valued at 42.22.
It's so stupid.
Revaluing it is something that I actually believe could happen, but I felt that it was too early for it to happen. I didn't think it would be revalued on July 4th. Ultimately, still may be revalued. And, you look at what's happening in Hong Kong, it may get revalued just by the market having a new price-setting exchange that actually is focused on immediate delivery instead of futures, where you'll have competition for real price setting. But price revaluation, sure, it has happened. It could happen. A lot of people talked about it. It makes sense. It would do a lot if revalued high enough to help. It's an accounting gimmick.
And I think that there might...
I don't think it'll happen if it does until gold is much higher. And then I could see it.
Yeah. And I think that there needs to be some things in place in order for it to happen. I think that the audit for, Fort Knox needs to be done. I think that we need to know exactly what we're sitting on or 100%. What we're not sitting on.
Do we need to know? The world needs
to know, right? I mean, it's been since, 70 years since the last audit?
I thought Luke Roman had the best take on it. He said he believed they would let gold rise organically to 6,000 or 7,000 and then potentially revalue it from a higher point.
Right, strength.
Right.
Not
only that, you don't have to, print so much money because it is an accounting gimmick through the Federal Reserve and the Treasury. But the gold-backed treasuries to this day still is the best idea I've heard, and I think it's not a dead-in-the-water issue. But it just goes to show anytime you focus on a date, it is it's a bad thing. I did talk about it a lot, but I never said it was guaranteed, and I said I hoped it would happen. And so I was just as disappointed as everybody else. Right? I think gold was up to $200 in 1973, and then it fell by 50% to $100. People dumped it, and then 6 years later it was $850, an 8.5% return in 6 years. The market wants to take as few people along for the ride as possible, like a bull. You have to hang on and ask yourself, where are we in a world where 40 trillion in debt, and if you raise rates, you blow up the system. If you lower rates, you exacerbate inflation. It's a system where, I think they'll choose inflation over blowing up the system and austerity. They won't choose austerity, or the whole game ends. That means more inflation, looser dollar. That also allows to easier path to paying down the debt, and easier path to reindustrialization of the country, which is what they want. Triffin's dilemma says if you don't, it's a wasted endeavor. So yeah, I think that's why, and this is why the central banks don't care about the anything, the flows, the interest rates, the price, the CPI, the employment numbers. They don't care. They just keep buying. And why Poland says we've been buying the dips.
Yeah, I mean, look, Rick Rule in one of his interviews was talking about, not today. He said, but if we look at what the dollar is going to do 10 years from now, and he surmises that if the dollar loses 75% more of the value over the next 10 years, then he absolutely can see the price of gold being north of that. I think he was 15 or 20.
You know why he says 75? Because I heard him say that he believes the dollar on average loses about 8% per year purchasing power.
Right. That's exactly what
So you have 8% reduction in purchasing power, and you're getting 4.5% on a treasury. Your real
minus
return
5.5%.
3.5 to 4%.
Yeah.
Yes.
With global debt currently spiraling past $40 trillion, monetary authorities are trapped in an inescapable dilemma where raising interest rates implodes the financial system, while lowering them supercharges inflation. In this fragile environment, policymakers will inevitably choose inflation over systemic collapse or harsh austerity. This deliberate choice means a progressively weaker dollar, which is projected to lose up to 75% of its purchasing power over the next decade, as it depreciates by roughly 8% annually. Consequently, gold is predicted to skyrocket well north of its current limits, serving as the ultimate shield against currency debasement. Central banks globally are already anticipating this decline, aggressively purchasing physical dips regardless of short-term paper price fluctuations. Real physical delivery will ultimately triumph over paper manipulations as the global monetary system inevitably resets. Now, let's get back to the interview.
There are a lot of people talking about the numbers on the COMEX exchange not really changing. And, I don't typically focus on the bleed down of COMEX as much as I do the deliveries. It's true, you could argue that the numbers went way up at the beginning of this year with the tariff threats and have come down. A lot left went to China. 6 months in a row, gold is the largest exporter of the U.S., and a lot of that is moving to the east, some back to London. But the deliveries on COMEX are very unusual. And even though the numbers don't change, and one of the things that I thought about, because that's a valid point, right? COMEX isn't being bled down per se, but what is unusual are the deliveries, the repetitive deliveries that normally were settled either by rolling forward, cash settling, or just exiting the position. And that's how a true hedger would do things typically. The deliveries are very outsized and very unusual. Now, who would do that? Who would take these huge deliveries and maybe leave it in the eligible category? I surmised perhaps, again, this is all supposition, but what if it were the U.S. government by proxy through banks under the Exchange Stabilization Fund because it's viewed as critical, but they don't want their fingerprint in the gold market. So they have banks, along with the shorting of the price, stand for delivery and leave it within the COMEX ecosystem in the eligible category, not for delivery, which would be registered, so that the crowd doesn't say, look at COMEX being bled down and create a panic. Instead, do they have to worry about anyone misappropriating their gold and silver? Most likely not.
Right.
So what I focused on was the deliveries, and I looked at the deliveries into China, where, in the first quarter they imported more silver than in the history of the country. They imported something like 45 billion in gold, in the first quarter as the price was being destroyed. We talk about, large deliveries on COMEX in February, 4.1 million ounces of gold delivered onto COMEX. Doesn't mean it left. There was 26 million ounces of silver delivered in February, 39 million ounces left. Some is leaving.
Mind you, all at the same time that the paper price is getting destroyed.
Right. So my feeling is, if you were the U.S. and you were thinking, geez, this is strategic, but if we jump into the market, it's going to create a big splash. What if we have proxy? In my big speech, I talked about how I felt Tether could be involved in this. But on the COMEX side, what if you have banks doing this for you, keeping it in house accounts under the name of the Treasury privately? The CME Group puts on their website, we do work with sovereign banks like the Federal Reserve. But what if this was the Treasury doing it on behalf of these, or doing it in association with the banks? As the price is shorted, they stand for delivery and leave it at COMEX so that it's just glossed over. Does that mean they won't start to take possession? Who did take possession of 39 million ounces of silver in February? Almost 2.9 million pounds drove away. So there is offloads, but to some of the analysts in the industry that are saying, but yeah, the numbers are staying steady. They are. But the thing is that there's eligible and registered. We have one COMEX vault in New York out of our 9 Brinks facilities. We have one client with 2 million ounces and 1,000-ounce silver bars ineligible. They're not for sale.
Right.
They're not to be posted for registered. So counting what is eligible isn't really fair because a lot of it isn't for sale at any price right now. So the point of it is simply this. There is validity in the fact that COMEX numbers aren't bleeding down, but what if the entity behind it didn't care and just left it there for now so as to not create a unintended consequence of it leaving in mass? What is unusual are the deliveries. Normally this never happened. And to see the volume of deliveries is something that should not be ignored.
Agreed.
That's kind of what I talked about, saying the biggest money in the world is inelastic in their purchasing, and they're buying more and more and more as the price is getting hammered. In fact, Adam Glapinski, the head of the Polish National Bank, came out and said he was happy to see that the price was declining as Poland has been accumulating copious amounts with each decline. This is the country that's bought more gold than anyone over the last few years. So central banks are price inelastic as it pertains to accumulating gold and actually taking advantage of the drawdowns.
The mechanics of the physical precious metals market are revealing unprecedented anomalies, particularly through the massive, outsized deliveries taking place on the COMEX exchange. While official inventory numbers appear steady on paper, the sheer volume of physical metal leaving Western vaults and heading east is highly unusual. Predictions indicate that this covert drain of Western physical reserves, driven largely by price-inelastic sovereign buyers like China and Poland, will eventually trigger a severe physical supply squeeze. Additionally, there is a strong possibility that sovereign entities are operating through proxy banks to quietly absorb delivery volumes without sparking public panic. As these massive offloads continue, the disconnect between paper prices and physical reality will inevitably break. This shift will force the market to abandon highly leveraged futures contracts in favor of immediate physical delivery exchanges. When the true physical shortage becomes apparent to the broader public, a rapid upward repricing of precious metals is practically guaranteed. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.